having again Mike Zuzolo, and he's going to speak about the stronger wheat prices that we are seeing in the last few weeks and that he has anticipated right here on Connected Farmer. We are going to speak about the delayed planting in Brazil, problems with crops around the world, and yet the US economic recovery right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Stay tuned and don't forget to subscribe. Mike, we are starting with wheat because you have anticipated all these stronger prices that we are seeing trading right now. So I'm seeing that just before we are recording this, the Rosario Board of Trade in Argentina reduced the output for this South America country to 17 million metric tons, down from 18 million metric tons. And yet, I heard about the worsening weather conditions in Russia. Sorry to make this question so long, but what are you seeing in there? Do you think this is going to last for a while?
Yeah, I mean, this is where we're getting into very lofty levels at this point. And I have to say, Luis, this is something that I've been expecting for 3 years. So it's been a long time coming. And, it's something that when you do your own analysis, you either have to really believe in it or you throw in the towel. And so it's not been fun waiting for this rally, but it's been rewarding finally to know that your analysis can be correct in a big, big way. But it's been a long time coming. And I think this goes back to why was it a long time coming? And I think it goes back to the Federal Reserve policy, which is a non-factor. In other words, it's not going to be a negative factor on prices going higher from here. But what could be a negative factor is the issue of increased COVID restrictions. You and I have also been talking about this. We're going to see London go into a lockdown. We're going to see Paris go into a lockdown. We're going to see 2, 3, 4 major countries starting this weekend go into major lockdowns again. And in the Northern Hemisphere, we're going to start the flu season and in the regular flu season. And so you do have weather on your side. And what's more important, what you have on your side right now versus what you did not have a year ago today was an unimaginable buying spree by China. And also that buying spree probably being due to their own production being hurt by droughts and floods. The demand that we're seeing from China, as I see it, and as things develop, yes, they're trying to rebuild their hog herd. Yes, they're coming on with their poultry flock, like we talked about last week. But I think it's also a supply issue in China that they are buying extra from other countries. And now the market is in a different situation. They have a Federal Reserve policy that's different. In fact, it's the exact opposite of last year. And they also have the world's largest commodity buyer in the market and in the market in a big way. And so to answer your question, as long as we keep that going, yes. As long as we stay dry, yes. You don't want to try and curb the upside potential in the wheat market if the weather stays dry and if China continues to buy here. But what we have to also think about on the back end is what COVID and these restrictions are doing to the global economy and what they could do to demand down the road. And what I'm trying to talk about with clients right now, and it's very difficult to establish this, but what I'm trying to talk about with clients right now is we are going higher to ration demand, cutting the demand out with higher prices. But are we also seeing a rationing of demand naturally because of the COVID and the global economic slowdown that we may start to see in the next couple months, in the next 3 months. And that's really going to be tough. And this is where you and I talked about, I think last week, is that sell and defend model: hedge, profit, buy it back in case the weather stays dry. That's the only way I see the pathway forward to getting profit and not giving up too much of the further upside price potential.
And we have reported also a lot of weather problems on wheat fields in Colorado and western Kansas. What are you seeing right now in your area in Atchison, Kansas?
Yeah, you were doing that 3 months ago when the market didn't care about it. I remember you had a Colorado person on from the either University of Colorado or someplace in that area that was talking specifically. Maybe it was the K-State guy, but I think this is, kudos to you for looking into this, because it matters now, and it matters to the market because China keeps buying. So what I'm seeing right now is in the soft red wheat belt of Illinois, which is typically below Interstate 70. Producers there are commenting about how dry it is becoming there, and they're worried about their wheat. We here, which I'm still in the corn and bean belt where I'm at, Luis, but if you go an hour and a half west, that's where the wheat belt really starts. So, say west of Manhattan, Kansas, and west of Wichita, Kansas, that's really where the wheat belt starts. But they are even drier and hotter than we are here. We are getting close to wrapping up our corn and bean harvest at this stage, because we literally haven't had one day that I can remember where we've been pushed out because of rain. And we have been topping 90 degrees. We've had a true Indian summer here, and it's extremely dry. So I was talking to a news wire about this just before we went on the air and trying to explain to them, you know this because you know agronomy, and I know this because I know producers who produce. If you have a bad stand of wheat going into dormancy, and dormancy is only a few weeks away now, if you've got a bad stand of wheat going into dormancy, you can't bring that stand back if it stays dry, and then you have a very bad winter. You can reestablish some of it and tiller some of the wheat out and make up some that way. But on such small acres here in the United States, in both parts of the wheat belt, soft red and hard red belt, I think it is a different dynamic than what the trade has been used to, and they're finally catching on. But here again, look at what's happening in the Paris wheat futures, Paris corn futures. Paris corn, after when we were going on the air here, Paris corn futures is at $5.50 a bushel. We just closed over $4 today as we go on the air. It's the same with the wheat market in both China and in Europe. We have a significant discount here in the United States when it comes to the futures market versus the Chinese Dalian exchange or the Matif coming out of Paris. And now, even today, as we go on the air, I saw where Brazil's Paranagua export price for soybeans jumped 3%. I want to say they're upwards of $500 a ton at this point. I can't remember the exact number, but I do know that the premium that Brazil and Paranagua is carrying now versus the United States Gulf and the Pacific Northwest is back to a $50 a ton premium. So we are competitive, even though we've had this sharp rally. That's what we really want to watch here in the next couple weeks.
Yes, and before we jump specifically into corn and soybeans, I would like to stay with wheat because of the domestic market in the United States. So we are getting closer to the holiday season, and a lot of different things are happening this year with the holiday season. There is more domestic tourism everywhere, so I guess there will be a different consumption. So how do you think this is going to impact the wheat consumption and the commodities in general?
Yeah, I think this makes a big deal for what your cash market can take and what the millers can take at this stage, because you're right. I heard Dr. Fauci say on a major news outlet that we may not want to get together for Thanksgiving unless you just know that the people you're getting together with don't have COVID. If you take a step back, Luis, and I think this is where your question originates from, is how much consumption are we going to lose if most Americans decide not to go and be together at Thanksgiving and instead have much smaller meals and cook much smaller portions and don't bake as much because no one's coming to the house, this really does materialize into a loss of consumption. And this goes back to my first point. Wheat is on the front lines of that. And that's why, in part, wheat is my leader. Wheat is my leader because it's consumption oriented, it's dollar oriented, it's export import competitive oriented. In other words, if Russia's there to take our business in the United States, they'll take it and take it quickly because we don't have the Middle East anymore to rely upon like we used to. So wheat is an extremely valuable barometer for not just the wheat, but for all of ag and especially the corn market.
And do you see more room for soybean increases right now? We are, as we speak, the Brazilian soybean planting is still delayed. We are going to have probably a delayed corn planting in the second corn crop next year. And yet, I just read a couple of minutes ago about the increase in disease on corn.
Yeah, I think what the USDA report and what the weather models suggest to me right now, the USDA took the US soybean production below 2018. They did not do that in the corn. And I think they're going to have to. Either that or they're going to have to raise bean production back up. I don't think you can have both of them, one above and one below. I think both crops either got hurt and are below 2018 levels in production, or they're both a little bit above. And so that's the USDA side. And on the weather side, I see a pattern change potentially coming for Brazil that would probably be just like in the nick of time, just in the nick of time to get Brazil's plantings back on track without losing the potential for 125 to 130 million metric ton soybean crop. And so I think in the next week to 10 days, we're going to be able to answer a lot both of these questions because we're going to be getting closer to the next WASDE report. US harvest is going to be finishing up, and then we're going to see whether those weather models are correct. So what I see right now, Luis, in terms of soybeans is they can go higher, but I think they need wheat and corn to help them go higher. And I think right after the WASDE report, we saw the beans try to go higher. Wheat was not ready, corn was not ready, and the corn and wheat traders decided not to buy, and beans fell apart and their prices went down sharply. Remember where the funds are with the commitment of traders right now. They're very long soybeans. They're near 2012 drought levels when it comes to their net length for soybean futures and options, but they're nowhere near that long in corn and wheat. So from a variety of reasons, whether it's weather, the funds, or the USDA report and what the trade is trading from the government statistics, I think wheat and corn have a much better position than beans for adding new longs. So if beans are going to go higher and get to that $11 plus mark, I think you really need to see wheat and corn do it. And we may have started to ignite that with what we were able to do with the new multi-year high in the soft red wheat as we closed out this current week.
And what are you hearing about the yields in the heart of the corn belt for both corn and soybeans?
Yeah, I've been doing a lot of talking on the phone to both elevators and producer clients, and I still feel secure going back to the USDA report that the corn on corn acres that we have here in the United States are being hit with a lower yield, even lower than normal. We expect about a 10 to 15 bushel hit on or decline in yields versus corn bean rotation. But it seems it's bigger than that for a lot of the producers, whether they're in Indiana and Illinois or whether they're in Nebraska. So corn on corn acres are getting hit. I'm also hearing now that some of the guys are getting really deep into the corn, that they have noticed that corn yields that go down versus up on certain parts of their farm can be traced back to their inputs, their agriculture inputs they didn't apply because prices were so low going all the way into the middle end of July. I've actually heard that from an elevator client as well, or elevator contact as well, that even in states like Illinois, producers decided to cut costs because prices were below the cost of production for the corn market especially. And so with that, they have seen a yield hit and taken a yield hit because of that. So I feel fairly solid that we are not going to beat 2018 in terms of production because of those two issues. So I would look for the later corn that was planted later to have more problems or not be as strong as the early planted corn when it comes to the yield per acre.
And looking ahead into 2021, I would like to jump into that about the investments. Do you see a jump on farm investment as we have a very low interest rates?
Yeah, this is going to be tough because I could see an environment after the US election where the interest rates get very, very high, very, very quickly on a fear, on worries of a sharp contraction in the global economy. And so if I set that off to the side and and I say interest rates, I'm not going to factor those into my analysis right now until after the election. The crude oil prices should stay low at this stage because our demand is not keeping up with the supplies. So if that is the case as well, then I think that what we're seeing when it comes to the 2021 outlook is a rougher period when it comes to getting these types of rallies generated again, unless we have weather. And so it becomes more singular, that maybe weather becomes more of a dominant player for the types of rallies we get. And does that answer your question?
Yes, it answers the question, and also I think there is more fear related to higher producer price index.
Yeah, and I think this is where it goes back to the sharp rally we've seen because of the change in the USDA numbers and the Chinese demand, the government outlays, direct outlays to farmers. You're injecting a lot of money into the farm economy right now, and the yields are good. And so farmers are going to need a tax shelter, and they're going to buy a lot of equipment, and they're going to probably try and get more acres underneath them by raising cash rents. And that's very dangerous because I don't know if that's going to last, if the market can support that type of injection. So that's what I've been talking to more clients about that, as far as, do you go out and buy a bunch of machinery to have a tax shelter, or do you just pay the tax man and not add more debt to your load and more payments to your load? And I think it's something you really have to think about.
And given the hardship that ranchers are facing right now, do you think it's time to sell calves right now?
To sell what?
Calves.
Um, I would say if you are in a good position with strong pastures, I think you're okay. But if you are in a drought area and you are seeing cash prices go higher, because like cash prices in your local region, not necessarily the futures prices, because there's areas still that the cash basis is fighting this futures rally. So the cash price hasn't changed that much in some parts of the country. I talked to a client in Southwest Minnesota this week, and he is going to break records on his corn, and some of his fields will average 280 bushels. They already have. So, I mean, if you have cow calf pastures in that part of the country, you've got cheap feed, green grass. I don't think you need to liquidate any of your herd at all. If you are in Western Kansas, Eastern Colorado, and you have Milo prices that are 60 cents higher than corn prices, you have no outlook for better or improved moisture, and your wheat crop has not really come up at all because it's not gotten enough rain. I think you're going to have to think about that.
Yes, I remember that since the pandemic started and we started this program, you mentioned that the dairy producers would be were suffering the most among all farmers. And do you think this scenario is still the same for them?
Yeah, I do. I do. I really do, because I don't know how you can, and I don't know how you can keep the level of milk supply and production going at these levels. And I'm not a dairy expert, but I don't know how you can keep these levels going without opening up schools and restaurants. We here in Atchison just had a 10-day or 14-day lockdown at one of our major high schools because our cases went over 5%. I mean, when you think about 5% of the population or more having COVID, and that stimulates a lockdown and you shut down a whole community, that is very stringent. And I'm not saying it's wrong. I'm just saying that really hurts your consumption. And I think dairy, cheese, these are on in the bread, like we talked about earlier. These are on the front lines of losing consumption. And Luis, the problem is we could lose consumption in those areas forever, or at least, you know, some of the major companies that do research and surveys are suggesting that 60% of the restaurants in the United States may be put out of business permanently. And so I don't think we have our hands around that right now. I don't think the stock market understands that. And I don't think the energy markets yet understand that completely. I think the market is assuming that we're going to get a vaccine that works. And by the second half of 2021, at the latest, we're going to be back to where we were before the pandemic. And I, as a risk manager, have to look at both sides.
Yeah, I also doubt it. Anything else to add, Mike?
Just my thanks for having me on. Many people are enjoying this, and I'm getting more and more positive feedback, and you're doing a great job, Luis. Thank you.
Because of you.
No, sir. You did it.